right. Good morning, everybody. Good morning to you, John Walkup.
Good morning, Noah. Time for some happy economic talk on Mondays.
I don't know how happy it's going to be. It's going to be economic talk, a little macro stuff. I don't know how boring, happy. All right, I'll take happy. We got some good stuff. We're going to talk about rates. We're going to talk about the Fed. We're going to talk about credit spreads. We're going to talk about Manhattan. Hopefully we don't lose the internet doing this, guys, because the internet's been choppy. I don't know, what's AWS thing, John? What's going on there?
It's an AWS thing. We were talking on Slack earlier, and we were having all kinds of connection issues. So hopefully that's not going to bother us today. But knock on wood, salt over the shoulder, whatever it is you do, let's do it.
Yeah, I mean, if you see us freeze up a little bit, hopefully it doesn't show in the ultimate thing, but that is why. So wanted to get that out of the way. But now let's start, Johnny. Let's start. Thank you to John Walkup for being here. I am Noah Rosenblatt. We are both with UrbanDigs, and it is Monday. So you guys are going to get a little macro Monday to come right at you. For those of you that are new to this show, we're going to start out with Manhattan real estate. I got it right up over here. Not a good start, John. And then we're going to go to some macro items, and we're going to circle back to Manhattan real estate. We're going to try to do all of this in 30 minutes or less. As usual, nothing we discuss here is financial advice, so don't start day trading this stuff. Okay, John?
Correct. That would be a bad idea.
Yeah, that would be smart. All right. I want to start out with the monthlies, guys. We're on the market snapshot. We're on 1 month over here. We do this every single Monday. Let's take a look at the trends. This is new activity trends. New listings, 1,422 new listings came on the market in the last 30 days. It's starting to go down. What you need to know is that average for October is 1,525, John. So we're trending below average as we get into the last week and a half or so. And typically, I would think that new listing volume as we get to the end of October slows versus coming on big. So I don't know if we're going to meet the average this month.
Well, it's interesting because that's exactly what happens, right? So September is the big month for listings, right? They all come on you got a couple of weeks right after Labor Day, which is bam, bam, bam. The listings come on, and they still keep coming on a little less, little fade action happening. So we're in that fade process. And I think what you're suggesting is, or not suggesting, what you're actually saying is when we had the listing volume for September, we were higher than seasonality. And now it looks like we might be in October, might be below seasonality. So a little flip-flop action there.
That's what I'm saying.
On the listing side,
September was high, about 300-400s high. And it looks like October is going to come in light, but we still got 10 days. We'll see what happens. But 1,525 is my norm. That's my benchmark. That's what I'm looking at there. Contract activity, that's supposed to be over 910. And we're at 815. So it's like it's going up. There's deals being signed, but we're still below average. I don't know. The next week and a half, this might go up because you got some low bars here. Yeah. If that gets replaced by big bars in the front end, that can go up. So still time there.
Yeah, we had some holidays early October, which those are sort of in the rear window now. So again, as you look at what happens on the listing side, that tends to fade into late October, whereas the demand side tends to start ramping up. So
right.
I don't know if we're in the real ramp up stage here. I mean, we should be. I hope we are. But if we're going to see it, this is when we'd see it. The last couple of weeks of October into November, that's when you'd see it. So there's certainly still a chance that we could have another season or another week. Oh, goodness sakes, I'll get it right. I think you're rubbing off. I think you're contagious now.
This is live, John. This is live. You can't just fix the recording and start over.
Let's just pretend I did. Let's talk about the month. So there's a chance that we might have another month of possibly above seasonal activity on the demand side, so like we saw in September. But again, we still have 10 days to go. We have a little bit of a runway left. So I'm cautiously optimistic. I'm sticking to that phrase for now.
Yeah, 9/11. 9/11 is the number right over there. 1525 is the number right there. We'll keep an eye. Next Macro Monday, we'll probably have a lot better idea where this is going to end. So we'll keep an eye on that. But I just want to remind you guys, regardless of these broad market trends, this is very low. This market is so local, so hyper local right now, guys. And if you just, I mean, you could, if you want to find out like what's going on, which sectors are hot, which sectors are not. I mean, you could sit here and play, but the way to do it is this liquidity pace chart. And just to give you an example, I'm going to go ahead and select all the bed counts, right? I mean, you could do price ranges and neighborhoods and all that stuff, but I don't have the time to do that for you guys. But you basically do this and you do it by bed count and you do liquidity and you wait for that to load up. And you're going to want to look at the year over year trend. All right. Hopefully this doesn't take that long to load, but you want to look at the year over year trend. And that is going to tell you what is under and overperforming over time. You know what, John? I'm going to let this come up and we'll come back later. Let's move on to credit spreads and we'll come back and check this once it loads up and I'll finish that exercise. Okay. Little note to self. Credit spreads right over here, guys. This is our canary in the coal mine. I'm starting out with the max chart first to show you guys that's the great financial crisis on the left. That's the pandemic right over here in the middle. When this thing rises, bad stuff is happening. Stocks are going down, risk off in the markets. When this thing is going down, it's the opposite. It's risk on. Okay, risk on, stocks can keep going up, et cetera, et cetera. When I look at this over the last month or so, we missed Macro Monday last week, John.
We
Columbus
did.
Day.
I mean, it's like the one time we had somebody to talk about on credit spreads, and it's like you see this bump happening. We missed it.
Yeah, it moved.
Okay.
Yeah, it moved up. It moved up. We actually went to stage 2.1, and then it came back down. And what I like to tell people is we did have a little hiccup in the stock market for a day or two. And what I like to tell people is when this moves up, like it moved up, we weren't here to report on it for the holiday, but this moved up to 2.1. When that happens, you look for follow through. You look for follow through. Is this now going to move up to the next level, or is this a one and done type of thing? And if you scroll out, okay, 6 months, let's go 1 year. If you scroll out to get the tariff move, right, you could see that this was one of those one and done. It didn't follow through. So I don't see anything going on here. I wouldn't be surprised if stocks continue to go up, John.
Yeah, well, I think it was a knee-jerk reaction to headlines that came out about tariffs being imposed, fresh tariffs on China. So you had that shock move up, and then the taco trade kicked in, and it kind of pushed them back down. But again, what this re-emphasizes to me is the fact that there is a lot of headline risk still out there, and all it takes is a little bit of reminiscence, a little bit of remembering that it's still there, and this will spike right back up. So I know that, when you zoom out and you look at that long-term action, from 2022 or so, when rates started first rising and we had that increase in credit spreads, we're in the long-term downtrend and we're still in that. But again, even though we're in that, you still have these pressures to the upside when these headline risks make themselves known.
Well, we'll see, because if you go max right now, it looks like it's low. And I'll tell you what's making rounds in financial world around here is this chart right here is making the rounds. They're basically talking about how corporate bond spreads are their tightest, are their narrowest in decades, right? So we talked about that here as well. You could see how this is down. We're talking about the exact same thing. So we'll keep an eye on this. This is typically a sign of maybe complacency, euphoria. But the point is, until this goes the other way, until this goes up, you're probably not going to see any sustained sell-off in the markets. And that's why we look at this. Okay, guys? I want to go back to that liquidity pace chart that just loaded up. Okay, remember we were showing you liquidity. I did all the bed counts. Take a look at the left: studios, 1 bedrooms, 2 bedrooms, 3 bedrooms. I told you guys, when you do this kind of exercise on UrbanDigs and you put a whole bunch of different things together, look at the right side of the table. Look at the year over year change, and you'll notice that some of them are green. Look, the 3 bedrooms and the 2 bedrooms are green year over year. They're green month to month. I could see that the 2 bedrooms and the 3 bedrooms are outperforming, whereas the 4 bedrooms look like on a year over basis are underperforming, and the 1 bedrooms and the studios are definitely underperforming. So if you happen to be in that sector and there's something going on that feels wrong, check it versus other sectors. That's how you do it. Sorry that took so long to load.
Well, no, but it's just a fantastic point about locality, and so this can even be defined by neighborhood, price point. But yeah, that's what happens in one sector does not necessarily what's happening in another sector. So that's
correct.
Always good to know.
Liquidity chart, guys. Liquidity. That is your right there. That is your deal activity chart. Okay, we ended on corporate bonds. Yes, I'm
gonna pause for a little housekeeping note. Jeffrey writes in and said, "Is there a way to make your screens larger or your font?" We've been working. We're trying to figure this out, and it's a little funky. But yes, we hear you. We're trying to figure it out, but it's not as simple as it seems. So
sometimes
we're working on something.
Sometimes I hear from users that when they're watching it on their screen, it doesn't look good. But when they change to a computer and go to the YouTube recording, then it's like, oh, it's bigger. I could see it. So I don't know. But just like what John said, we tried overlays and we're trying screen share, and both of them have their pros and cons. So we're trying to figure this out. It's not
But
easy.
thank you for the feedback. Please keep it coming. Also, keep those comments coming. We keep an eye on those while it's going on. So we'd love to have a little discussion in the comments that we can tap into.
Yeah, well, let's move on to Fed Fund futures. Hopefully there's a little
Okay.
chatter to do with that, guys. This is our mortgage rate pivot, guys. This is our mortgage rate pivot. This is what the market is looking at. We call it the Fed Fund futures because that's what it is. It is the Fed Fund futures. Basically, the bond market is trying to predict what the federal funds rate, that's the rate that the Federal Reserve controls and lowers and raises, stuff like that, on their future meeting dates. If you look at this table, guys, meeting date, take a look at these dates. It goes way in the future. Rule number one, we're not going longer than 2 meetings out. Okay, that's just two. Once you get past 2 meetings out, your percentages start to go way, way, way low. So we could use this as an informational guide as to what the markets expect, but expect it to change. So if it's going to change, you don't want to start giving advice on things that's not going to be true in 6 months. We got to protect our reputations at all costs. What you need to know. Okay, we are here 400 to 425. That is our current level of Fed funds rate. The next meeting is October 29th. There is a 99% chance that we have a quarter point cut, basically priced in. And December 10th, next meeting, 94%, another quarter point, 2 cuts priced in, John. I think it's coming.
Yeah, well, I mean, I don't want to go. Who wants to go against the 25th? That's 5 days away. It's 99.9% chance.
No, not that one. Definitely.
That's obviously coming. It's the next one. You still have a little bit of room there, but it's pretty certain as well. So, yeah, I think we got 2 cuts coming. The key, though, and this is why we actually look at this, is how's this going to affect mortgage rates? Because we've already did. It already did, but the question in the future is like, how much is there, right? We've seen the front end come down quite a bit. The 2 years come down quite a bit. So if you look at the yield curve, actually, right? So bear with me because I like to talk yield curves. That blue line is where we are today, and you can see on the very far left side that's the repo rate. That's the overnight rate. You can see the red lines where it was last year at this time. It's significantly down, and you can see in the middle the 2Y, that 2 year on the bottom. We're down significantly compared to where we were last year. But look at the 10-year, and that's what mortgages price off of. It's down, but just a tiny bit. So even though the Fed has made steps to really cut that rate, and the 2-year has responded and it's down, and this is actually still an inverted yield curve in the middle, we haven't really budged much on the 10-year. And that's why mortgages are in a downtrend, true, but it's super slow. And we're not getting that action that we would normally associate with, like, oh, wow, rates are down, mortgages are down, the buyers are back. So we have rates down. Yes, mortgages, and they're making their way down, but it's kind of like 2 steps forward, 1 step back kind of thing. And it's not enough to really reignite the engine, especially in the financing dependent sectors in our markets in Manhattan and Brooklyn, like 2 million below sort of thing, or nationwide in some of the Sunbelt markets.
Yeah, that's interesting, John. That's interesting. I mean, yeah, the front end, this left side, the front end of the yield curve is way, way down on expectations the Fed's going to make moves, right? The Fed does not control that longer end, that right side, that 10-year, the 20-year. The Fed doesn't control that. That's the market. The Fed only controls this left side. So that's an interesting point, John. And if you take a look at rates, this is how it all parlays into rates, guys. This is why we look at this table and we look at what's expected and what the Fed's going to do, and we say these terms like priced in. Take a look at these rates since what, like August? It looks like. I mean, when the jumbos were over 7, now they're at 6.33. I mean, I'm starting to hear that people are getting 5s, good 5s on relationship banking with some rates. So it's a good setup from this point of view. And this is now priced in. It's pricing in 2 cuts. So when these cuts come, when this cut comes in 9 days, and this cut probably comes December 10th, you may not see mortgage rates go down further. They may actually stay where they are. Or they may actually go up higher because the market's already priced it in.
Yeah, okay. And just to be, again, you got to be careful what you wish for on Fed rate cuts. So it's not enough just to have lower mortgage rates. You have to have an environment in which people are interested and want to buy. And that brings up, Scott writes in the comments, does this take into account the upcoming election? So I assume you're referring to the New York City elections, right? Those are coming up. So no, this does not take into account those, because those are a local thing, and these are national rate policies, which no one really cares what happens in New York City. It's just Manhattan. It's just an island off the coast of America. So for rates, it doesn't really matter. But yes, to your point, Scott, that's the environment in which people buy, and that does take into account the election. So I don't think there's any clarity yet on which way this market is leaning. I'm talking about the Manhattan and Brooklyn markets. I don't think there's any clarity yet on which way this market is leaning, whether the election's good, bad. Is this a good time to buy, bad time to die? But who knows? Who knows?
Yeah.
It's just, we'll know in, I'm going to say, March, April, once we have clarity.
Spring season. Right.
Season.
We'll find out. I mean, we're going to know in a couple of weeks, right? The fall season pretty much ends in November. We're going to end on that. We're going to end on the seasonality of our markets and what the takeaway is there. But we basically got 3-4 weeks left, and peak activity is supposed to be like now for our markets. I mean, once you get to early November, it's going to probably start fading. So keep an eye on that. But rates are down. Rates are down. I don't see them moving seriously higher unless inflation starts to rear its ugly heads. But this is surprising given what the stock market's doing. I got to tell you that much. The fact that you're having risk on, credit spreads so low, stocks at highs, and rates going down like this, strange.
Well, so Rhonda writes in the comments, I'm just going to post this up. This is an interesting one. I heard 33 states are already in a recession. Is this true?
Probably.
I don't know, but I wouldn't be surprised. And I think, you look at that trend in mortgage rates, they are going down. And we actually have some stats on the national housing market and pricing. And it's like, look, rates are lower, but nothing's lit that fire back under buyers. So I can understand that there could be a recessionary environment in some of these states simply because the buyers aren't buying. It's sort of a symptom of a recession.
Yeah, that's a good point. There's definitely a housing recession going on outside of our little bubble of Manhattan. We'll get to that in a second. But John, maybe rates are down because of this. Is that, on one level, the Fed's cutting. That's part of it. But maybe also this is the compression. This is the spread between 30-year and 10-year Treasury yields. A couple of years ago, that was close to 3%. And last year it was at 2.5%, and now it's down to like 2.35. Average is 2. Like I couldn't draw it on this chart, but basically it's been high since the pandemic. It's been high, and it's just gradually coming down. And what that means is that that's an added element. You got rates over here, and then you got kind of risk and other stuff over here. That's on the risk side. So that's coming in. That's also one reason why rates are coming down. So we were talking about this a couple of years ago. The idea that rates could come down even without the Fed doing anything. Right. This is sort of eased as this economic environment has become a little bit more normalized. I would say there's definitely still some room there for the compression to keep compressing. Yeah, that's a cool shirt. Compression. Yeah, get our mortgage rate compression socks on. Yeah, and mortgage rates going up in 2022, and then now they're starting to come down, right? I mean, go back in time 3 years, they went up from like 0. Mortgage rates went up, and again, you think national housing market. We've shown you guys a whole bunch of Lance Lambert's maps and all that kind of stuff. But this is different. This is looking at Lennar, looking at one of those new development companies, one of the bigger new construction companies. They peaked out in end of 2022. It's clear that the rising mortgage rates 3 years ago, 2022, basically it peaked. It marked the peak of the housing peak outside of our world. And over the last couple of years, 23, 24, and 25, those markets have been rolling over. So, you talk about are there 33 states out there in an economic recession right now? Probably, because there's definitely 20, 30 plus states that are in a housing recession, and we don't see it in our market. We don't see it. But this is Lennar down 22% in terms of their asking price per house sold in the last 3 years, John. Crazy.
Right. And then, you bring back in that mortgage conversation. You think that you can definitely see a little uptick there. Look, we've seen mortgages have been in this slow downtrend, but it's not enough to reverse this price trend for Lennar Homes, right? Because essentially they need their buyers to be financed in order to afford it. So they got to get the mortgage. So even though mortgages are coming down, it's not enough to, like I said, light that fire under them to get them back. I mean, maybe it'll stop the slide right around here because it seems like this is where it was almost before pre-pandemic. So maybe we'll get a little holding there. But just to your point about the housing market recessions, you actually might see some in Manhattan and Brooklyn, but they're going to be very localized. Like you might see problems with, say, and I'm just guessing. I don't know, but this is just a guess. But you might see something like the Upper East Side Yorkville studios might be having a problem, whereas the Upper East Side 2-bed co-ops might not be having a problem. So you can see that it's very, very micro markets are having issues, whereas, it can be masked by larger zip code level or even borough level statistics about, demand and supply. Like, oh, the market's doing great. Well, why can't I sell my unit? Because this sector sucks.
I'll tell you, yeah.
Pardon my French.
The sector sucks. The temperature of the listing climate is challenging in a lot of local areas. We talked about that in the beginning with that liquidity chart. You can go local and find out what's going on. But there's also a lot of forces going on right now. Like buyers are just not giving any money back for renovations. Like they're just not. And they're penalizing unrenovated. And if you were renovated 10 years ago, we talked about this on Friday. Well, John, you weren't gone. You were gone. But yeah, I didn't want to do our regular thing. I want to do something different. But there's a knowledge gap. There's a knowledge gap between what sellers think their renovation 7 years ago and 10 years ago is worth today versus what buyers are willing to pay for that. We'll get to that in a second. I got a chart on that. But let's just finish this really quick. Home builders, I wanted to show this chart really quick. Prices are coming down outside of our market. They are in a recession. There's a lot of regions in housing that are multiple years in a recession, not in the Northeast, but outside of our bubble, there is. And a lot of the inventory is home builders. 27%, average is 15%. You're at 27%. So that's high. Ever since the pandemic, hasn't really come back down. Now, I promised you a couple of things. I promised you that renovation decay. I think that you guys need to take a screenshot of this. I don't care. I put it on the Friday thing. I think this is a concept that is not often talked about, but is critical because I think there is a misperception between buyers and sellers on how many years since a renovation and how much money am I getting back. So this chart tries to talk about that. And I hear the same thing over and over again. 7 years ago, it's 10 years ago, but it looks great. It looks great. It looks like it was done yesterday. And it's like, yes, but it was 10 years ago. It's probably lived in, and buyers are just not, they're not giving it. And that's the point of this decay chart, John.
Yeah. I mean, shameless plug. These are the charts we developed for our UrbanDigs advisor reports. Always happy. Feel free to reach out to me, John, to UrbanDigs. I'll happy to talk you through it. But yeah, I mean, look, what's interesting is when we first did this, it's changed over time, and that bump you get from new to nice used to take a little bit longer, and it's steepened a little bit, especially post pandemic. And that's the way the market is now. And that curve down to a state where you're just getting massively penalized has also steepened. So it's at some point the buyer walks in and the seller's like, yeah, you may have heard me say this before, but I renovated it with my bare hands. And they're like, that's great. I'm going to have to redo the entire thing. So even though it might even be 15 years old, the buyer's thinking, I'm going to rip out everything. I got to put everything in. So it's a new world of renovations. And more importantly, it's a new world of how buyers are viewing the process of renovations and what their expectations are. And that's how we have to really manage it. What is that expectation from the buy side point of view walking in?
I got to be honest. I even think that's mismanaged today. I feel like everyone's throwing out these numbers of price per square foot, that $700, $800, $1,000 price per square foot. I mean, again, I feel old when I'm saying this. Back in my day, $250, $300 a square foot would be a decent renovation. Well, I'm not talking about like gold, everything, but it was a decent renovation for $300 a square foot. Now it's like the minimum I'm hearing that you would even consider is $500. It's just escalated. And I don't know if the inflation element is nearly as bad as that period in time years ago when that 300 went to 1,000, right? Which was after the pandemic. That inflation element, we just tripled it, kind of a thing.
Right.
I feel like materials and stuff has come down, maybe not labor, but the headache of doing it and all that stuff, buyers are double penalizing.
Well, I'll tell you something else, which is really interesting. We also used to have a spread, and I don't think we've done this in a while, for at least on Macro Monday, but we've talked about the difference between renovated and unrenovated, what that spread looks like. And it completely blew out during the pandemic, right? It was almost like a 30% gap between somebody that needs work and somebody that's, ready to go. That has since closed the gap a little bit. I think we're in the maybe slightly under 20. We're somewhere around there.
16, 17, I believe.
Something like that. But over the last year, I'm starting to hear a lot more of the staid, Upper East Side, Sutton Place, these sort of 50% down plus co-ops who like to see, 20 times the purchase price in cash. You know who those are. They've been starting to say, all right, well, we're going to relax the summer work rules a bit. So I think even they're starting to get the memo that, hey, listen, buyers are expecting to do some work and they're not going to wait until summer to do it. And they don't want to do 5 years of summer work to get it done. So
Yeah.
Hopefully there's a little something there, but again, this
Yeah.
market does not turn on a dime. So hopefully get some progress.
Question from Lita: is something that was new development 10 years ago the same renovation decay? I mean, to some degree, yes. I mean, maybe not down to zero kind of a thing, but there's definitely a decay factor in these new. What's up, John?
Well, you have a chart for that. Thank you, Lita. That's great.
Oh,
so it's
I don't have it up now.
This is I know, but it's a double whammy because
I didn't remember to
I
put
mean,
it up.
I could talk for minutes about this too, but let me just say my piece.
Go ahead.
You have a double whammy because you have the renovation decay, but you also have the new dev decay, right? So when you're a new dev, it's like an IPO, you trade at a premium. As you age, obviously the things in it age and you have that replacement cost that's going to be associated with it, but you're also aging out of new dev. And so after like 10 years, you're not a new dev anymore, you're a resale. And so you're getting penalized. So you don't get that little premium to that. So your price is fading in line with resale plus the renovation. So it can be something dicey, especially if you bought 2015, 16, 17. Like we've had a lot of conversations recently with sellers saying, listen, your place is fantastic. It's really well located. It's great, good views, etc. But you're not going to break even. Sorry to be the bearer of bad news, because the market's just not rewarding this. That they're rewarding the new devs, they're rewarding those turnkeys, but this is neither. So you don't get that.
Thank you. Good answer there. Hillary, private lending trouble is concerning a lot of financial people now too. That is true. I will tell you that on the financial Twitter that I'm following over here, there's a lot of people talking about how the regional banks are getting hit. A lot of other banks are getting hit. A lot of the credit companies are getting hit, and that there's some liquidity drying up in the credit markets that's not displaying itself in credit spreads right now. So I feel like, do you remember before the great financial crisis and the Bear Stearns hedge funds and all that kind of stuff? It's like it matters until it doesn't matter, and it doesn't matter until it matters. That's like how this all works right now. And when those Bear Stearns hedge funds went down and the stock market kept going up, but the credit spread started to tell a story, it mattered. So whether or not this is going to turn into something systemic, that's yet to be seen. Until then, I don't see it. So it's very interesting. The answer is yes, that's what's going on. All right, guys. Excellent conversation on renovation decay. Thank you, John, for the new dev decay. Excellent question, Lita. I want to end right here, guys, on Manhattan seasonality. John, you made this little index, so to speak, which is like a derivative of our optimal time to list chart that we use to find the waves of seasonality, so we could ride the wave, right? That's right, man. Serve that wave, baby. So you got to know where you are in the whole cycle in the wave, and it's clear that the fall wave, guys, we are in it. We are in the fall wave. We are at the peak of the fall wave. We are surfing. We are turfing, right? But it's not going to last forever. So if your client seller is waiting to do a price cut for after the election and after Thanksgiving, why would you do that, right? At the same time, if your client's going to list after the election or in December or January, if you got the listing and it's a secured thing and it's not a timely element for your client, they can wait a couple of months. Maybe it's better to wait till spring. I'm just saying, from a strategic seasonality point of view.
Yeah.
Go ahead, John.
That's right. Well, we actually had a Forbes article out on this, and basically it's interesting because when you start slicing and dicing the market, obviously you can't get too granular, but when you start, you're looking at neighborhoods and price types and property types and price levels, you start realizing that some of the seasonality curves are different than others, and some peak in different points of the year than others. And we're actually doing a report for a unit in which the peak was actually October. That was the seasonality peak. So that is the market. Some markets peak early and fast, like February, March. That's the peak. Again, it really helps to know when the buyers traditionally, that's not always the case, but just traditionally, that's where the most active periods of time are. But yeah, so right now we are in the fall wave. As you can see, it is not as strong or as long as the spring wave, but it is short, it is sharp, it does fade. So hopefully we can make the most of it while we can.
Right. Kara, we got some good questions from Kara. We know Kara very well. If 10-year-old condos get the double whammy, then why would buyers invest in them? It's a great question. I mean, and we're talking about investors right now. We're talking about investment. I mean, I don't know. I always feel like there's a lot of investors are just not aggressive. There's not an aggressive, large investor pool running to throw money into New York City condos. I mean, I just feel, I don't know. Maybe I'm wrong. I'm sure there are here and there and that kind of thing. There always is. But like the way it was 10 years ago, I just feel like we're at a much lower level. Policies. I also feel like maybe the sales price doesn't match what the rental rate's coming in from a math point of view. And this just from a math point of view, the math was not mathing, but there's always investors. But John, how would you answer that question?
Well, it's tricky, right? Because I mean, look, if you're buying a new dev condo, right, you know what you're going to get. It's the shiny new object. There's competition for it, so you get it, you feel great. But there's really kind of buyer remorse kicks in about like 5 to 10 years down the road when it's no longer that new development. The flip side is these resale condos. They're not old. Maybe they need a little bit of work. The whole idea, though, is that you're now in a more stable environment than you were a new dev. So you're not going to lose that sheen because you don't really have it when you're buying something that old. So you kind of got it. You got something that's going to be a little bit more stable. So obviously co-ops, generally speaking, are the most stable of the prop types because it's a lot of work to get in, a lot of work to get out. And it's not really faster money, so to speak. But in the condos, the resale condos typically have a little bit of a smoother line than the new devs because the new dev, that premium just starts decaying over time. And so you don't necessarily recover that. But in the resales, I suppose my answer would be that it's just less to keep track of, maybe. If that's sort of a cop out, but that would be my guess.
I like when the audience kind of answers also. I mean, Carrie's clarifying here. I mean, a buyer, primary occupant who just wants to make a good decision. And Hillary, where's Hillary over here? Same reason they buy anything else. It's what they want, where they want, when they want, for the price they want. What a great answer.
Like, it is. So I guess if you're thinking about, I guess what's your end use? Are you going to rent it out? In which case you're most likely, I mean, if you bought it for cash, I mean, you have to realize what your after tax or after cash tax rate, all that stuff is. Usually don't break even. Usually there's a little bit of a loss. That's just how it goes if you're buying something retail. So I guess the question is, what do the numbers look like? Can you get a high enough rent on that new dev because it's that shiny new object to sort of, bridge that gap upon what the resale rent might be in a certain
you'll probably
location, et cetera.
You'll probably get more of a reaction from the rental market in terms of the condition than the sales market. That's what I think.
Yeah.
And the rental market going up is the rental market is starting to close the gap between that what is my cost to carry when I buy and what is my cost to carry when I rent? You know what I'm saying? So it's starting to close. What's going on? You got a little smirk in your face there, John.
Well, these are just fantastic questions. I love it. Kara comes back. What if the end user just wants to make a profit on the sale in 10 years? That's tricky. And I think this is what's really interesting because this is where our expertise as professionals comes in, because a lot of that has to do less about the nature of the building and more about the quality of the building, the location of the building. Like, is it something that can stand the test of time? Like, there are some new devs that have popped up that were flashes in the pan, and then you look back later, it's like, well, it's not that hot right now. So there are the ones that have come on now that do stand the test of time. It's really, really, really hard to have a crystal ball for 6 months. So 10 years is kind of like, I have no idea, because you think about all the people who bought in 2015, they're like, this is a fantastic investment. I finally got something, got my piece of the pie. And now they're going to sell. And they're like, wait, what? How did that happen?
Yeah, because in 2015, you just came from 2010, and from 2010 over the last 5 years, we just did nothing but appreciate and go up and up and up and up and up. Remember that conversation with Noam Newman, excuse me. Sorry about that, Noam. And he thinks the sales market, hey, listen, the sales market will have its move. The sales market will have its move, but it is years away. It's the rental market's time. Let the rental market close the gap. Rents are going to get so high, there's going to be frustration, and then the gap between rents and sales is going to close a little bit, and then all of a sudden the sales market's going to look like a value, and that's when it's going to start a run. In the meantime, inventory is just going to crunch, and everyone's eating off each other's plate with the scraps that are left out there in the sales market. That was the thesis. And I still think that's in play. He was talking 27, something like that, 27, 28. So we're in 25. So we'll see what happens there. I also agree with Robin. The new devs now are building towards a community lifestyle that young professionals want to live in. That's the thing, right? We're trying to figure out, like, a building 10 years ago that might be trading at a discount. Is it B because there's a renovation decay and a new dev decay? Could it be also that? And could it be that the new developments that are out there today have a complete amenity set difference or a style difference or something else difference that's more reflective of today's buyers versus 10 years ago? That's constantly evolving and constantly changing. And these lifestyle things, cold plunges, red light therapy.
I know, but even I mean, look, the New York Times had a front page article, front front screen article at
Front
the top
screen.
Stephanos Chen, who is fantastic, did one of these virtual, walkthroughs of his article where he's talking about 432 Park and cracks that have developed in the facade because the concrete mix was optimized for looks and not maybe for performance. It's a whole long story, but that building was trading at crazy premiums when it was built. And now you have a story like this coming out, like, is it the kind of location that screams, yes, I want to live there? Well, no, it used to be, but now it's kind of like, well, it sways, the water in the bathtub is moving, there's cracks in the facade. Like, these are kind of things that like are really, really, really going to take a bite out of that new def premium for that building, especially now that it's 10 years old and has been featured on the front page of the New York Times as cracking. So it's like, it's not what you want as an owner in that building. So
probably not. Dale, we're all looking for the next Williamsburg 2010. Absolutely. And, you can always find value in this market. I mean, you want to find value? Go find something that's 140 days on the market. It's in bad condition. It's buildings got a temporary assessment going on. The carry's a little temporarily high. You're gonna find that's impossible to trade. Like there are properties right now that are being so penalized right now. There are some deals happening, and we see them. John and I see them. We're doing these reports, and we see them, and we see where they bought them. We see what they put in them, and we see where they're trying to trade now, and they're not getting it. And it's like, I don't understand it. So there's definitely value out there. You just have to find it.
I know. I wish I could have. I should just create my little portfolio of like what I call market steals, because I have seen some absolute steals right there in this market today. It's like if I had the cash, I'd buy it.
That's like a new show.
Could be if you had the cash. I'll call it If You Had the Cash with John.
Yeah. All right. Well, we've circled back to the end, guys. Thank you so much for lasting this long and staying with us. We really appreciate it. I just want to point out on Thursday, we're going to be talking with Stephen Kliegerman and Jason Thomas over at Brown Harris Stevens New Development. And we're going to talk about the new development market. We'll talk about all that kind of stuff. It'll be an interesting conversation. Both these guys are fantastic. Other than that, Johnny, thank you so much for what you do. That is John Walkup. I am Noah Rosenblatt. We are both with UrbanDigs, and this has been a Macro Monday. Catch you guys next time. Good luck out there, guys.